Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Amova-StraitsTrading Asia ex-Japan REIT Index ETF that has the SGX stock code CFA. This video is done as a follow-up request from some viewers' comments in my previous videos. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos, and I'll be happy to work on it as long as I can find enough information on the product. Amova Asset Management is the rebranded name from what was previously known as Nikko Asset Management. The rebranding was done on 1st September 2025, although it took nearly a month for them to update all the relevant fund documents to the new branding, which I was waiting for before making this video, so that all the extracts included in this video are consistent. The company was formed in 1999 from the merger of Nikko Securities Investment Trust and Management and Nikko International Capital Management. I personally like Nikko Asset Management as a better identity for its origins, so I don't really understand why the rebranding needs to be done, but that's just me. The company was briefly acquired by Citigroup in 2007, who sold it to Sumitomo Trust and Banking in 2009. Post some mergers, the parent entity is now known as Sumitomo Mitsui Trust Group, a big conglomerate in Japan. Amova is the directly owned subsidiary. While having a strong Japanese heritage, Amova brands itself as a global asset management firm and operates in 10 countries and regions globally, managing over $260 billion of AUM as of June 2025. Amova's product solutions outside of Japan onshore mainly revolve around Asia in both equity and fixed income aspects. There are efforts to produce more global solutions, but this is not easy, especially that the number of fund providers and fund solutions have grown significantly over the years. The other company mentioned in the ETF name is s-reit, that started off as a commodity and resource producer, but over the years expanded into property and hospitality sectors. The ETF was launched together by the then Nikko AM and s-reit in 2017, hence the inclusion of both companies in the ETF name. There is, however, strangely no mention of s-reit in the ETF documents, so it appears the company now has completely no involvement in the product at all. The Amova-StraitsTrading Asia ex-Japan REIT Index ETF doesn't mention the fund manager in the webpage or fact sheet. It is, however, stated in the prospectus, together with a detailed manager bio as seen here. Lai Yu Huan is the principal portfolio manager as well as the head of Asian equity in Amova. His LinkedIn data shows that he has worked in Amova for over 14 years, focusing on Asian equity solutions. There is, however, no information on whether there are any other co-managers or on the investment team that supports Yu Huan. Before we go through the strategy of the Amova-StraitsTrading Asia ex-Japan REIT Index ETF, let's understand the index that this ETF tracks, that is called FTSE EPRA Nareit Asia ex-Japan REITs 10% Cap Index. Another very long name, so let's break it down. FTSE or FTSE refers to FTSE Russell, one of the global leading indexing provider that is a subsidiary of the London Stock Exchange Group or LSEG. FTSE Russell is known better for its equity indices, in particular the FTSE 100 Index for UK equities and the Russell Series for US equities. EPRA stands for European Public Real Estate Association, and Nareit stands for National Association of Real Estate Investment Trusts in the US. They are both well-recognized data establishments focusing on real estate sector in Europe and US respectively. In 2005, the three companies decided to work together to roll out listed real estate indices with standardized methodologies. The offerings soon grew beyond Europe and US to cover global markets and regional markets including Asia ex-Japan, which is how the benchmark index of this ETF came about. The FTSE EPRA Nareit Asia ex-Japan REITs 10% cap index was created with a base date of end 2008, which gives it nearly 17 years of track record. The index factors free float and liquidity of the positions in the screening process, and positions are reviewed on quarterly basis. The 10% cap in the ETF name means that there is a 10% cap per position, so that the index is not overly concentrated in a handful of positions. This is being adjusted during the quarterly reviews, so it is possible to still see a handful of positions exceeding the 10% in between the review periods. The index is pretty concentrated, with only 43 constituents, which is about 40% of the broader unconstrained universe. Average market cap is around $1.5 billion, and dividend yield is at 5.83%. Looking at sector breakdown, we can see the index has excluded many diversified REITs and all residential REITs from the broader universe, presumably because they did not pass the free float and liquidity screening. Given constituent weights are allocated based on market cap, there is a big overweight to Singapore REITs as they typically have larger market cap compared to other REITs in the region. As a result, Singapore by country exposure is around 2/3 of the index, and the top 10 holdings are dominated by Singapore REITs. We will therefore compare this ETF with Singapore-specific REIT ETFs later to see if there are any meaningful performance differences. Now that we understand the underlying index better, let's move on to the ETF itself. The Amova-StraitsTrading Asia ex-Japan REIT Index ETF is a passive ETF, which means the investment objective is simply to track and replicate as close as possible the performance of the underlying index, which is the FTSE EPRA Nareit Asia ex-Japan REITs 10% cap index. The prospectus actually has a pretty long section on the investment objective and approach. It also elaborates on the index and further clarifies that the index excludes Australia, New Zealand, and Japan. The ETF has a quarterly distribution payout. Distributions can include natural dividends from the underlying REITs as well as capital gains. We will look at the actual distribution used later. The ETF uses a full replication strategy, meaning it will invest in all the index constituents and follow the same weightings in the index. This is the most common approach for passive ETFs. There is a long section talking about financial derivative instruments usage, although the ETF currently does not have any, and full replication strategies don't usually use them, so this is not of any concern. More general clauses follow, but I don't think these are of particular importance as well. The prospectus then states clearly that this is a passive ETF, so there is no expectation for it to outperform the index. Lastly, given the ETF is listed in Singapore Exchange, holds many Singapore REITs, and intended primarily for Sing dollar investors, the base currency of the ETF is Sing dollars. The Amova-StraitsTrading Asia ex-Japan REIT Index ETF was incepted and listed on the Singapore Exchange in 2017, giving it about 8 years of track record. It actually comes in two trading currencies that are the base currency Sing dollars and also US dollars that is simply an FX conversion from the daily Sing dollar price. The ETF currently has an AUM of about 600 million Sing dollars and charges a total expense ratio of 0.55% per annum. The AUM and fees are similar to the Lion Philippe s-reit ETF that I covered in another video previously. The ETF uses a different sector classification, so the sector allocations look quite different from the index data. In particular, some of the positions are reclassified from diversified sector to industrial and retail. I can't say which classification approach is better, though this one used by the ETF gives it a much more diversified spread across the sectors. Country allocation-wise, Singapore takes about 2/3 of the portfolio as mentioned earlier, with Hong Kong and India next on the list. There is a mention in the ETF marketing brochure that the growth of Asia REITs have been significant, although it is unfortunate that this has not translated to a more diversified country exposure in the index and the ETF. For example, more into Thailand and South Korea, presumably due to the free float and liquidity screening constraints. Given the ETF uses a full replication approach, the top 10 holdings are obviously the same as the index constituents. There are small decimal differences in the weightings, as the ETF needs to additionally have a small allocation in cash equivalents for liquidity purposes to facilitate the subscriptions and redemptions. The ETF has a 0.26% 3 years annualized tracking error, which is decently low and shows the ETF is tracking the index prudently. The distribution information of the Amova-StraitsTrading Asia ex-Japan REIT Index ETF is found by downloading the distribution summary Excel file in the ETF webpage. The Excel file is not yet updated, and we can see it still refers to the old Nikko AM name. The ETF seems to try to provide a stable quarterly distribution payout, as the distribution amounts have been quite similar. As a consequence of this, it is not possible to rely on just the dividends of the underlying holdings, so the ETF needs to use some capital to cover the difference every now and then. Based on the distribution data, the ETF currently has around 5.5% per annum distribution yield, which is slightly lower than the 5.8% for the index. The Amova-StraitsTrading Asia ex-Japan REIT Index ETF provides a simple performance table versus the benchmark index in its webpage and fact sheet. From the longer time period data, we can see that the ETF has quite consistently lagged behind the index by about 0.7% per annum. We can also see that the performance of the index and the ETF have been quite weak, giving only an annualized return of 2.41% for the ETF and 3.15% for the index since inception in 2017. This is far lower than the 5.5% distribution yield that the ETF has, so we will need to understand how badly impacted the NAV of the ETF has been. Here is the price versus total return chart of the ETF since inception. We can see the only time when the ETF had meaningful capital growth was in 2019. It then corrected together with the broad market when COVID happened in 2020 and never quite recovered since then. It dipped further during the high interest rate period in 2022 and 2023 and seems to claw back some returns year to date as interest rates come down again. For the whole period non-annualized, the total return was about plus 20%, but the price was actually down by about minus 20%. So that means the distribution yield totaled to about 40% worth. Here is the calendar year returns from Morningstar. Some viewers previously mentioned that REITs are supposed to have correlation effects with interest rate movements. So let's use this data to take a look. Given the portfolio is mainly Singapore REITs, I have added here the Singapore 3-month SORA data for reference. We can see that the ETF had the best performance in 2019, followed by year to date. 2019 was a flattish year for 3-month SORA, while year to date we have seen a sharp decline in the rates, so there doesn't seem to be correlation here. Singapore already started trimming interest rates in 2014, and the ETF delivered negative returns, so it doesn't seem that REITs necessarily do well in declining rate environments. On the flip side, the ETF had its worst performance in 2022, which was a steep rate hike environment. It didn't do so bad in other rate hike years though, so again, the correlation is not consistent here. So if anyone tells you REITs will definitely do well when interest rates decline, do not assume it is true and do your own research. There are often other market factors affecting the returns. Similarly, given that 3-month SORA has been cut substantially from the highs of 3.75% in 2024 to the current 1.45%, it is hard to tell how much more upside the ETF has going forward, even if there is a correlation between REITs returns and rate cuts. Next, given the ETF has about 2/3 of Singapore exposure, let's compare the ETF against Lion Philippe s-reit ETF or CLR to see if there are any meaningful differences. Here is the full performance chart, and we can see that CLR has outperformed CFA, especially during the COVID period. Both ETFs have, however, performed nearly the same post-COVID since late 2022, as seen in this chart. So there doesn't seem to be any meaningful differences in returns between the two. One possible approach to pick between the two would be your preference on specific REITs. As seen here, the top 10 holdings in the two ETFs are somewhat different, as the different index methodologies end up with different priorities and weightings for the REITs. Another consideration would be that Amova-StraitsTrading Asia ex-Japan REIT Index ETF has a larger geographic market coverage, and in future can give better diversification when the other countries besides Singapore get bigger allocations in the index. Regardless, as of now, there is not much difference between these two ETFs from a performance perspective. So, as with what I did in the Lion Philip s-reit ETF video, here is a comparison of the ETF against Amova Singapore STI ETF or G3B, representing the broad Singapore equity markets. The Straits Times Index or STI has a significant allocation on the three local banks, so the exposures of the two ETFs are rather different, with one focusing on Singapore REITs and the other focusing on Singapore banks. Remember 2019 was the best performing year for CFA, so let's trim the time period a little to see how it looks after 2019. Here is the chart from 2020 onwards, and it shows the two ETFs have basically moved in very different directions. For this time period till end September 2025, G3B has outperformed CFA by nearly 80%, which is a significant amount. Even with year to date, where some investors are hoping for a rebound in REITs, we can see that CFA has still underperformed G3B by about 4.5%. So personally, I think going for Singapore equities through a STI ETF is still a better play than going for a Singapore heavy REIT ETF, even at this time. With that, let's summarize our findings. Amova Asset Management, previously known as Nikko Asset Management, is an established Japanese asset manager that is relatively small compared to popular global fund providers, but is decently recognized in Singapore and Asia. The Amova-StraitsTrading Asia ex-Japan REIT Index ETF is a passive ETF that tracks the FTSE EPRA Nareit Asia ex-Japan REITs 10% cap index with a small tracking error, which is good from a product perspective. The index is created and managed by reputable global parties and is part of a broader range of indices focusing on listed real estate globally. While the index is meant to cover the Asia ex-Japan region, it currently has a high concentration of about 2/3 allocated to Singapore due to the market cap weighting as well as free float and liquidity methodology. This results in the index having a performance similar to a pure Singapore REIT exposure, which is not ideal. The ETF provides a smoothened quarterly distribution payout of over 5% per annum to provide consistent income to investors. The long-term performance since inception, however, has been weak, averaging only about 2.4% per annum since inception, which means it is not sufficient to cover for the distribution yield. This is not a product problem, but it's really that Singapore REIT market has not been strong in recent years. For investors who have the view that REITs are supposed to do well during declining interest rate environments, I have shown that this assumed correlation is questionable. In conclusion, the ETF currently does not really provide a more diversified or superior performance compared to pure Singapore REIT ETFs at the moment. It would make more sense to revisit this product only when the index has a more meaningful spread across the Asia countries instead of concentrated in Singapore. The overall performance of Singapore REITs, while decent this year, has been a concern for me with its longer-term track record. For investors who like REITs, I think it may be better to use this ETF as a reference to pick and choose from the top holdings, the better performing REITs to invest in, rather than going for the full portfolio of REITs that has a mix of good and bad performing ones. This concludes my absolutely biased comments on the Amova-StraitsTrading Asia ex-Japan REIT Index ETF. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.